Session 9 of chapter Change in Profit Sharing Ratio. In our previous session, we have discussed how to prepare a revaluation account. Now, when the revaluation account is prepared, all the assets and the liabilities are revalued and reassessed, and in the balance sheet the increased or decreased value of assets is shown and the increased or decreased value of liabilities are shown. Unrecorded liability and unrecorded assets are also shown in a new balance sheet after the reconstitution of firm. But what happens if the partners they decide not to show the increased or decreased value of an asset? They do not want to show the change or the revised value of their assets and liability in the new balance sheet. Then in that case, the assets and the liability will not be, the value of the assets and liability will not be changed. They will be shown in their old values, but the adjustment entry is done. In that case, the adjustment entry is passed and the net effect of revaluation is calculated. Now let's understand what is to be done if the partners they decided not to show the revised value, not to show the revised or the changed value of assets and liabilities in the balance sheet. In that case, we will first calculate, the first step will be to calculate the net effect of revaluation. Now to calculate the net effect of the revaluation, if there is any increase in the value of asset will be added. In that we will add any decrease in the value of liability because it is a profit for the business, and if there is any decrease in the value, these are positive points, and if there is any decrease in the value of asset, it will be deducted because it's a loss for the business. If there is any increase in the value of liability, then again it's a loss for the business. So after doing all these adjustments, whatever amount we left, that is the net effect of revaluation. Suppose it is a 50,000, then this net effect of revaluation, it will be distributed among the partners, not in old ratio. It will be distributed in gaining and sacrificing ratio. Now then, what journal entry is passed for that? This net effect of revaluation will be distributed among gaining to sacrificing partner. If it is a profit, if this amount net effect of revaluation is coming in positive, it means it is a profit. Then the journal entry will be gaining partners capital account debit to sacrificing partners capital account, and this amount will be distributed among both the partners in gaining to sacrificing ratio. And if it is a loss, if this net effect of revaluation is coming in negative, it means that it is a loss, then this entry will be reversed. Then in that case, the journal entry will be sacrificing partners capital account debit to gaining partners capital account if it is a loss. And in this case, when we will prepare the balance sheet after the reconstitution of the firm, after the change in profit sharing ratio, when we will prepare the new balance sheet, in that case the assets and liability will be shown in their old value. The revised and the new value of assets and liabilities are not shown, but the increase or decrease in the value of assets and liability, we have calculated that net effect, and that net effect will be shared by gaining to sacrificing partners in their gaining to sacrificing ratio. If it's a profit, then this journal entry will be passed, and if it is a loss, then the journal entry will be reversed, that is sacrificing to gaining partner. Thank you.